Hello friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. So my privilege is that I am here with you to talk about innovative debt instruments. This is the series we started in the previous session, and we talked about two important debt instruments, zero interest bonds and deep discount bonds. There are so many more innovative debt instruments. I shall be talking about few more debt instruments in today's session. I would preferably cover security premium notes, floating rates bonds, and maybe callable and puttable debentures or bonds as well. So, and we will continue with these innovative debt instruments in future sessions as well. So, friends, we all know what debt is. If you have happened to listen to my previous session or happen to read about it, debt is something which is extended in the form of a loan or advance or as an investment by one person or a institution to the company, right? So, the issuer of the debt. So, in expectation of getting some interest, payable may be 6 monthly or payable at maturity or payable after few years, depending on what is the format or the design of the instrument. So, innovative debt instruments do not pay no interest on regular intervals, or they may have certain unique features than a normal debenture or bonds, where we have a fixed known interest rate and the face value is known, maturity is known. They are simple debt instrument known as debentures or bonds, but the innovative ones would have something unique, something different. Either they are linked to market, either their interest is floating, or their interest is not paid at all during the life but at the maturity, like that. So, in that series, the next instrument I would like to talk about is secured premium notes, SPNs. So, what are secured premium notes? SPNs, they serve as a pool for companies to raise funds, right, while offering investor a combination of debt like safety, potential equity upside through warrants, and the possibility of attractive tax treatment or benefits on returns. So, that is very interesting. They serve as a tool or where which company use to raise funds. Of course, we are talking about innovative funds, innovative debt instrument. Any debt instrument for that matter helps a company to raise funds, right? That goes without saying. So, they are offering this in combination of debt like softness, no, security or safety, because there is a rate of interest, with a possibility that you can convert your SPNs into equity, into ownership after certain period if we have the warrants issued. So, that is a unique feature in the SPNs. For example, TISCO, Tata Iron and Steel Company, they are considered pioneer in issuing SPNs in India. In July 1992, they actually issued a mega right issue. Mega right issue means where SPNs were issued as a loan instrument with an option that the investor can convert that debt into equity, can get, if the investor is sure, like after 5 years after the lock-in period. So, if the investor is sure after the lock-in period, then the investor can decide to become owner. So, that shows the confidence that the investor gained confidence during the period. Mostly the companies will issue at that time. The companies may not have that much credit worthiness, but gradually the owners, the investors would see potential opportunities, potential growth in that company, and they may decide to buy the, to convert the warrants into the ownership, because warrants are issued at the time of when the SPNs are issued. Now, one important thing, what is the feature? What are few features about secured premium notes? The first thing is they are debt instruments, because ultimately the debt is being given by the investor. So, SPNs are debt security, though they are in hybrid form, because the debt is given and with an option to convert it to the ownership after some time, with a promise to so there is a promise for the fixed return, right, and up to certain period, and when the warrant matures and an investor decides to convert the warrant into your ownership of the company or equity, then there is no promise, of course, right. So, that is why we call them as hybrid instruments, and they have detachable warrants. So, that gives holder the right to buy a company's equity share at a predetermined price even. The best thing is the price, the market price could be something different. You know, a buyer who has bought the SPN, or investor in fact, he would have the option to exercise warrant or not. After 5 years, after 7 years, whatever the lock-in period was there, at that time the company's market share price would be known to him or her, right. So, the person, the investor, can actually compare either to exercise warrants or not, or exercise the right to convert the warrants into equity or not, basis on the market price, or otherwise basis on the past 4 or 5 years performance as well, right. So, that is how the equity shares at a predetermined price can be purchased with the help of these warrants. This is the special feature of these debt instruments known as SPNs. Then there is a security. SPNs are generally secured by some collateral, usually assets of the issuing company. Most of the times companies will issue assets against issue SPNs against certain assets. It could be building, it could be plant, furniture, machinery, etc., etc., offering more security than unsecured notes, because the debts, debenture or bonds could be both secured or unsecured, like, but generally companies struggle to issue unsecured one, but reputed companies can still do that, right. But here security premium notes are always secured, because there is some kind of assurity, some kind of asset being given as a collateral by the company. The return is fixed. Investor receives a fixed return over a specified period, making them appealing to risk averse investors. Those investors who are risk averse, who are not happy buying or investing in equity share, or who are not happy with the flexible rate. Here the rate of interest is known in advance. Somebody knows that how much would I be getting as an interest, my returns are known to me, right. So, fixed return gives more confidence to the people who are investing in it. Another feature is there is a lock-in period, which is mandatory lock-in period. It could be generally be from 4 to 7 years, during which the interest is paid. And then there is a tax benefit. SPNs were originally when they were started or used in India or otherwise worldwide, when they were originally introduced or designed, the purpose was to give tax benefit. How? So that the returns on the investments were treated as a capital gain, because SPNs are issued for long time. So, that time the provisions were such that the tax was paid treating the returns as capital gains, because the rate of interest on capital gain is less than the rate of return on the short term gains. So, that is how they were designed, were perceived initially in the initial years. So, they attract lower tax rate compared to regular income of any business. Now, the secured premium notes, they have redemption option. So, after the lock-in period, the investor can there are 3 options an investor can exercise for redemption. Can sell SPN back to the company at its par value, whatever the value was given on the face, that can be used. So, they can be sold back to the company at the par value, or they can be converted to detachable warrant into equity shares. If the warrant were there, the owner, the company, the investor can become owner of the company. Or the third option could be they can continue holding it for the rest of the life and can wait till maturity to get the principal money along with the interest, of course. So, these are the three redemption options a company can exercise or an individual will face or will have to opt for. Okay. Now, what are the merits and demerits of secured premium notes? So, the secured premium notes are very much like debt instrument. The explanation which I shared is that there is some kind of flexibility as a merit. The owners can decide to postpone the mature the payment or the maturity amount. They can wait till the maturity date, or they can decide to become owners during the life after the lock-in period, or they can sell it in open market. So, there are so many more merits. This has a certain fixed return rate. It is a very innovative instrument of debt. And then limitations, certainly those limitations are there which we generally have for any of the debt instrument, that returns are low, the risk is higher, and then the life maturity is longer. So, these are the couple of demerits for SPNs, merits and demerits both. Now, I would like to talk about the another instrument which is known as innovative instrument. So, here I want to talk about floating rate bonds, FRBs. The floating rate bonds, FRBs or floaters, they are debt instrument that features a variable coupon interest rate, right. How do they differ from others? They feature a changeable variable coupon rate, interest rate, which is periodically adjusted, of course, based on the trend, what are the benchmark, what are the trends in the market, interest rate such as the repo rate, etc. So, or the rate of the treasury bill or commercial paper. So, the funding in floating rate is coming, how the funding is coming to the company, right. They get debt, of course, but the floaters are the instruments where there is a variable coupon rate. That is a beautiful, that is why we call them as floater. So, the rate of interest floats, changes. The periodic return of the coupon rate helps to align the bonds return with market value. If we compare periodically, right, the coupon rate, which is the interest rate, the returns on the coupon rate help us to align the bonds return with the market rates, because they are flexible in nature. Then the floating rate bonds have another feature, they are variable coupon returns. The interest rate on the rate bonds is not constant, but it fluctuates, as the name says, it fluctuates over bonds life. So, that helps to beat the inflation, that helps because they are generally decided basis on the market rate. So, that helps you to reduce the risk, directly the risk is been taken care. Another feature is that benchmark linked. The coupon rate is linked to the preset benchmark rate. For example, the RBI floating rate saving bonds, in actual RBI has issued them, they are linked to the National Savings Certificates rate, NSC's rate. This is a real example of the floating rates which are issued by RBI. Okay. So, they are floating rate saving bonds, known as saving bonds, and they are linked to the National Savings Scheme certificate or National Savings Certificate NSC's rate. Okay. Now, another thing about floating rate bonds is that the periodic reset. The coupon rate is reset at the pre-announced intervals, such as every 6 months or 1 year. So, this is a good thing about the floating rates in bonds, because your coupon rate is redecided every 6 months, is reviewed, is redetermined. So it is of course decided at an interval which is known to everybody, maybe after 6 months, every quarter or every year, but generally after every 6 months. And they are aligned with the market, because mechanism of the floating rate bonds is that helps to keep the bonds return in a sync with the prevailing market rate, because they are floating, they are linked to the market rate. The market rate could be treasury bill rate or FD rate, right. So the risk goes down, satisfaction goes up for the investors, because they are confident about their returns, because they are not going to get less than what the market returns are, right. There is certainly certain decimals point or certain basis points higher return in case of floating rates than the normal interest on FD or any other investment, right. So when it comes to evaluation of floating rate bonds, the advantage are reduced interest rate risk, regular intervals or income, and diversification. And limitations are decreasing income, reinvestment risk, credit risk and liquidity. So let me explain these points to you. So advantage, I am saying the first one is the reduced interest rate risk, because your returns are in the form of interest and which are linked to the market rate. So the difference of the standard rate or the market rate and the actual you receive is your risk. So the variability between what you expect, what you get and what you get otherwise if you don't invest in the company, the variability and the difference between the two is less, right. So the reduced interest rate risk is something very good, very big advantage in case of floating rate bonds. And the income is regular for floating rate bonds, because it's not that your income is been held for 20 years. You are paid by the company on on regular basis, and that rate of interest varies, that changes with the market rate. And the third is diversification. Is an option of diversification to the investors, because you are linking your returns are linked to market. It's an automatic diversification. It is the most effective diversification, because your returns are not dependent on, on the fixed rate which was announced and is applicable for 20 years, 10 years. No, your rate of interest is actually changing as per the market rate, and your portfolio gets diversified, because you may have certain investment in equity, certain investment in preference share or debentures, simple debentures, but here you are not getting a fixed rate of coupon on your debentures. Here you are getting rate of interest linked to the market rate, so some basis point higher than the market rate. So you are well diversified, because market rate varies as per the trends, right, as per the forecasts. So disadvantage are the ones which of course needed to be discussed here. The first one is decreasing income, reinvestment risk, credit risk and liquidity. Decreasing income, what does it mean? So if your because there is a possibility that market rate goes down. For example, if SPNs were issued, that the rate of interest would be 2% more than the treasury bill, right, and the rate of interest on treasury bills goes significantly down, what will happen? Your interest would also go down significantly, right. So that is a decreasing income. Reinvestment risk of course is there. You are if you are assured of a particular amount of return for a particular span of period, your returns are assured for that period. If we put a FD for 5 years, we know we would be getting 7% rate, 6.4% rate for 5 years, for 7 years, for 10 years. But here in case of floating rate bonds, we are not doing that. We are getting returns basis on the floating rate, right. So your investment risk is higher, because if on the one hand your income is going down because the market rate is going down, on the other hand whatever you will earn as interest, and if you want to reinvest it in any other security, there is a high risk, because you are already your interest in the market is going already has gone down, right. So your reinvestment risk goes really up, and credit risk is certainly there, because credit risk is always there for any investor into debt, so that you are not sure about the credit will be paid or not. And then the liquidity. So another risk for the company is that the company may not be able to pay. The company, it causes issue to the company, because company has to pay interest higher than what the market is offering. So there is a issue of liquidity as well from company's perspective, and from investors perspective as well, that you will be getting your amount at the time of maturity. Now the last thing I want to talk about is callable and putable bonds or debentures. So callable and putable bonds are fixed income securities with with embedded options that give either the issuer or the bondholder the right to an early redemption. A debenture is a type of bond that is not secured by collateral, right. So in debenture generally we will not have as any collateral. That is how it is a debenture, that debt form is debenture. So what is callable and putable? The word says call, another word is put. Callable, putable means those bonds or those debentures which can be called. Called by whom? Called by the company to surrender, and put means option in the hand of investor that they can put after a certain period, right, on a pre-decided date. So callable and putable bonds are fixed income securities, very much like any debenture, that gives option to issuer or bondholder the right to an early redemption. Either company will redeem those debentures early or bonds early than the maturity date mentioned, or the buyer will simply surrender them and will demand for maturity amount early than the due date. So both have certain special right, but callable and putable are two different types, right. I hope you are able to understand that. So callable bonds are basically contains a call option, as I said, or call provision that grants the issuer the right to buy back and bond from investor before its scheduled maturity date, right. So it means this gives an option to the company, to the buyer of seller of the instrument. An issuer typically call a bond when market interest rate they fall below the bond's coupon rate. Very simple. When would a company like to call? Let us say I issued debentures with a call option at the rate of 9% 2 years ago, but now today the rate of interest is 6%. So the company needed to behave wise, prudent, and since company has an option, or because the debentures were call options, having call option, the company would do what? Company would like to redeem those, because otherwise company would be paying at 9%, and then company may issue another set of debentures at 6%, because today's current prevailing market rate is 6%. So that is what the callable bonds are. So if company issues a 12-year callable bond with a 8% interest rate and market rate falls down to 6%, company will decide to call 8% bonds and issue new debt or new debentures or bonds at a lower rate. This was the case or example for these callable bonds. Now the merits and demerits of callable bonds are what? A firm has flexibility to influence debt at a lower rate, to refinance debt at a lower rate, similar to the refinancing a mortgage. This can be respond to changes in interest rate or cash flows. If company is able to get the same amount of funds at a lower rate, is able to bargain, negotiate with someone, or is actually the interest rate is going down, the bank rates have come up, this gives company a flexibility, right, to refinance, because in callable options the refinancing is possible. Investor reviews a higher coupon rate to compensate for risk of the bonds being called early. On the other hand, investor receives a higher rate, because when any callable options are given, the company cannot sell it easily. Company has to give an option of a higher rate of interest. So, the coupon rate for the callable bonds or puttable bonds both would have higher. Now, a firm need to offer a higher coupon rate than a similar non-callable bond. This is a demerit from company's perspective, and from investor's perspective, investor faces reinvestment risk, which is a risk of having to reinvest the principal at a lower interest rate. The bond is called and the price appreciation is limited, right? If the price appreciation is limited and company has already called up the bond, so there is no possibility for you to continue in that bond. You will have to get whatever the maturity amount was, and then your reinvestment options are kind of closed, because there are not many. So, there is a risk that you may not be able to get the same interest which you were getting otherwise. The last thing is puttable bonds or debentures. A puttable bond gives the investor or the bondholder the right to sell the bond back to the issuer at a predetermined price on a specified date before the bond's maturity, right. Here the option is given to whom? Who would be exercising the power to redeem? To get it redeemed would be the power of the investor. The investor would decide that, see, I do not want to continue, I will surrender it, and the rate and the time, they both are decided in advance. They are known to both investor and the issuer. And these puttable debentures, investors, they typically would exercise the pull provision with interest rates rise significantly, or issuer credit quality decreases, deteriorates. An investor can redeem principal money and the reinvest it in the any new high yielding securities. So, that is the feature in the puttable debenture. So, from investors point of view, they can exercise this right to put the debentures, and then they can reinvest at a higher rate of interest, because that is why they are selling it off. I mean, they are surrendering it off to the company, and they can invest in a high yielding securities. So, merits and demerits of the puttable bonds are: a firm is able to offer a lower interest rate which reduces borrowing cost. If the company is issuing puttable options, interest get protection against rising interest rates and a potential downfall in the issuer credit quality. Also gets liquidity into their portfolio and provides a shortcut exit strategy both. And the limitations are: a firm carries the risk of leaving to repay the debt early. If investors exercise the put option, of course that is going to happen, which requires them to have sufficient funds in hand, so that if the put option is being exercised by the investors, company is able to pay, right. And investors accept a lower rate coupon rate than other comparable debt options. That is the another demerit from investors perspective. So, friends, I hope I was able to help you understand these three debt instruments which are innovative, be it SPN, be it floating, or be it callable or puttable option. In fact, callable and puttable are two different, so you can take it them four. So, I hope I was able to help you understand these important debt instrument, and this is the time to wind up, friends. Thank you very much.